All right, so let us continue with the sources of finance. And in the last video, as we were discussing, um, the short-term sources of finance can be bank overdraft and then creditors. What are creditors? Creditors are those people from whom we take the goods on credit, and also called accounts payables. They are a very important source of finance. Instead of borrowing money from the bank and going and then giving that money to trade creditors and buying the goods from them, uh, that does not happen. This becomes a spontaneously generated form of finance. It happens in the regular course of the business. Okay, so they give us, let's say, a finance for 60 days or 90 days, for example, and I have to pay someone after 90 days. So what happens is that I pay them after 90 days, and when I return the money, I only return the actual amount. There is no interest on it. There's no premium that I have to pay on it. On the contrary, many creditors give discounts for prompt and early payments. So that is an advantage of having this kind of finance in the short term. As I said, debt factoring. What is debt factoring? There is a certain finance house called the factor, and if I have some debtors, people who are going to pay me, or accounts receivables, so and I need the money today. They are going to pay me after 60 days, but I need the money today. Let's say I need $1,000 today, and I have 1,000 in debtors, but they're going to pay me after 60 days. So what do? I go to this finance house. I tell them that, look, I'm going to receive 1,000 60 days from now from a certain person. So what they do is they take that person on their books, and they pay me against that. They give me cash against that, but they are not going to give me full $1,000. They're going to give me somewhat less, let's say $900. So with $900, a significant amount of what I require I have got, and they give me $900. They take the assets worth $1,000, and after 60 days, my debtor, is going to make a payment directly to them. So they gave me 900, they receive 1,000, 100 is their profit or interest, whatever you want to call it. So that is how the debt factoring business works, and it is a source of finance for the business. And this process, by the way, is called discounting. They buy the debtor at a discount. They will not buy it at the full face value or the book value of the debtor. Okay, then we go to medium term financing. Medium term financing, when we talk about, we're talking about mainly hire purchase and leasing. So hire purchase is, when you talk about hire purchase and leasing, basically talking about renting. You take an asset and you rent it, and then you pay monthly payments on it, which are called rentals or installments. There is just one difference between hire purchase and leasing. In leasing, you take the asset, you use it, and while you're using it, you're paying the rent on it, and then after you've used it, you return the asset. In a hire purchase, that does not happen. In hire purchase, first you hire the asset, you take it on lease, you take it on rent, and later on, when you have used it, you pay a certain amount, and then the asset is transferred to your name. You become the owner. The title changes hands in hire purchase. In leasing, you do not have to buy the asset at the end of the term of the rent. Then we go to the long-term finance. Long-term finance includes long-term bank loans and debentures. So what are debentures? Debentures are basically uh, debt instruments. They are certificates that you issue, the company issues. It is a source of disintermediation. What do you mean by disintermediation? You remove the borrowing from the bank. You don't borrow from the bank, you borrow directly from the lenders. And how do you do that? You give them the certificate, and let's say the certificate has a value of 1 million, so you will get 1 million from your debenture holder, the person to whom you sell, and you will use it for a certain period of time. Let's say for 5 or 10 years, you're going to use those 1 million, and every year you're going to pay an interest on that 1 million. Let's say you pay 10%, so you pay 100,000. At the end of the 10 years, your entire amount, the 1 million, will be returned. That is the important thing in the debenture. Debenture is not permanent capital. It's not something which you will get to keep. It is something that you have to return with the once the term of the debenture ends. And by the way, that's called maturity. Then the debenture matures. That's the word that we use, maturity. Anyway, so that is the first thing. The idea here is to borrow money directly from the public. The second is long-term bank loan. Okay, long-term bank loan. You borrow money from the bank, uh, a huge amount of money, let's say, because you need that money for the long term. So there are two possibilities in this case. Either you have fixed interest, whatever the interest rate is, whatever is agreed in the beginning, that is what you continue to pay for the period of the loan. Or there can be variable interest. Variable interest means the bank will say, look, we're giving you the money, but if the interest rate changes, then we will change the interest rate as well. Okay, so that is one source of finance, long-term source of finance. This debenture and loan are both debt financing. So when you're talking about long-term source of finance, you're talking about either debt financing, money which you'll have to pay back, or equity financing, which is uh, permanent finance, which you do not have to return. So how do you get permanent finance? You get permanent finance through the sale of shares, and that is what a company can do. It can sell more shares. um, that's a method of making money. Or if you're not a company to begin with, you are a partnership or a sole trader, then you can become a public limited company. Of course, there are advantages and disadvantages, which are in the other chapter, but this is one thing that you can do. You can go public. Okay, so how do you go public? You create an advertisement in the newspaper, which is called the prospectus. You inform the public. But by the way, this is a legal thing. So by putting it in the newspaper, you are announcing it legally that you want to issue these shares to the general public. And once the general public purchases the shares, then you have got a permanent source of finance. Okay. If you are issuing additional shares, then sometimes the existing shareholders, because they do not want to lose control, so the existing shareholders, they are given the first right to buy the shares, and that also at a discount. Such an issue is called the rights issue. So what is the evaluation of debt versus equity? So debt, definitely, please do keep one thing in mind: debt finance is always cheaper than equity finance. Okay, now that's the word we use, leverage. What do you mean by leverage? What's a lever? Something that is itself not very heavy, but you use it to lift something which is heavier. So loans are not very heavy when it comes to cost. They are cheap, but with that you can finance the business. Also, uh, these loans are they will be repaid. Another thing is that if you are a company and you have taken a loan, the lender does not get to vote at the annual general meeting. He is not like a shareholder. He is not going to have any authority to dictate the terms of how the company is going to work. Okay. The interest is tax deductible. That is a very important advantage. the government reduces its tax as a proportion of the interest. So that is a saving. In fact, that is a positive cash flow, a reduction in a reduction in a tax. And we are going to see this through an example how this happens in one of the later videos. Okay. Equity capital, of course, is permanent, and there is no obligation on you to keep paying dividends on them. The dividend rate is higher. There is no doubt about that. The dividend rate is higher than the interest rate, but there is no obligation on the directors to keep paying the dividend. If in one year they feel that they are not in a position to give a dividend, they don't declare a dividend. But that is not something that you can do with interest. Interest you have to pay no matter what. Okay. Then there are other sources of finance that a company has. One is grant. Grant is like a gift of money. Okay, they are usually given for research or things that the government or some agency is interested in developing. Then there are venture capital. Venture capitals basically are those firms which lend money to risky ventures. People who have ideas, but they cannot raise money from um, the normal banking channels. So they go to these specialists who specialize in taking risk and investing money with people who have new and bright ideas. This form of financing has led to a lot of innovation in countries where they exist. Okay, let's now quickly look at. Then there's another thing which is called microfinance. Microfinance is a very small amounts given to people with not a lot of resources, and they can then use this finance to set up their small businesses. Please keep in mind that whatever you are a form of finance you're using, everything needs to be put in a proper business plan. Planning, there's the saying that plans are useless, but planning is essential. Plans do not guarantee 100% success, but they force you to think strategically. So all these things are then put into a business plan, and which finally helps us formalize the business decision. All right. One option is equity, one option is loan. All right. So I hope that this was useful. Thank you very much indeed.